Welcome to Business Owner Bootcamp, the Wealthspire Advisors podcast designed to help business owners and entrepreneurs take control of their finances. Hosts and financial advisors Michael Delgas and Sandy Wiggins break down key topics like tax strategies, exit planning, business valuations, and real-world experiences with expert guests. And now, here are your hosts, Michael Delgas and Sandy Wiggins.
Good morning. My name is Sandy Wiggins. I'm a managing director of Wealthspire in the Richmond, Virginia office. And today we'll be talking with Carroll Hurst on the Business Owner Bootcamp podcast. Carroll is a CPA in Richmond, Virginia, works with families, high net worth families, and also in the M&A side of the equation. He is a founding member of Kiter, a well-respected CPA firm in the region, and has been working in the M&A activity for really since 1996. His sweet spot and that of his firm is deals between 20 million and 100 million, although he's obviously done things a little bit bigger and a little bit smaller than that range. So Carroll, thank you so much for participating in our conversation today.
Thanks for having me, Sandy.
Yeah. So what we want to do in the Business Owner Bootcamp is really talk about the considerations that business owners need to be thinking about, preparing for, avoiding in the development of a plan to exit. And there's lots of considerations from tax to market conditions to the strength and weakness of the company and its leadership. And so our goal today is to gain from Carroll's experiences and just have a conversation. So what I'd like to do, Carroll, is start off with the question, if I'm sitting in the seat as a business owner and I want to begin evaluating my exit strategy, in your experience, what's one of the first things that needs to happen?
Well, if you're thinking about possibly marketing your company for sale, I think one of the things that you really ought to do is to make sure that you have a good team around you to help guide you through that process. In my experience, that team normally consists of an M&A attorney, a CPA with background in tax and M&A transactions, and a financial advisory services firm such as yourself. Particularly if the financial advisory firm might have ex-investment bankers who are now in the financial advisory space, but have investment banking experience that could assist the client's management team and ownership group in thinking through a process and when the best time might be to start marketing the company. That is ideal. But at the end of the day, you really, most of our clients probably have 75, 80% or even more of their assets tied up in their business, which is an illiquid asset. And so from an asset allocation standpoint, there are a lot of factors that go into the determination of, how much liquidity the ownership group and their families might need. And that is something that the financial advisory firm can be super helpful with in advising the owners.
Yeah, and the team you spoke of, sometimes it takes a lot of interviews if you don't have that team already put together. How much lead time do you think you need if you anticipate exiting? How far in advance do you want to begin thinking about it, planning, and putting this team together?
Well, there's a lot to unpack in that question, Sandy. One of the questions that I think the ownership group needs to think about is where are they in terms of their current performance, earnings, margin percentage, top line revenues, what kind of growth have they been seeing? Do they think it's sustainable? What is, are they in a cyclical business or not? Do they have recurring revenues or not? Um, all of those things are factors that influence timing. And in addition to that, you've got, age and health considerations on the part of the management team that factor into when to go, as well as, how much the ownership group might want for the company. There are bands, um, that I would say, particularly financial buyers look at, in terms of, the size of net earnings, earnings for interest, taxes, depreciation, amortization. Within those bands, when you exceed some of those bands, you kind of move up, in the threshold of multiples of those earnings. And so, if you can get multiple expansion as you grow the firm, that can contribute to, a much larger exit value. So there are a whole lot of things to take into consideration. I would say it could be as short as 6 months. It could be as long as 2 to 3 years if, a growth plan needs to be executed before the company is really ideally ready to go to market.
Yeah, so the takeaway there is, if you're beginning to think about it, it's best to put some science behind it, get a team of folks together that can help guide you and identify things that might need to be done in order to enhance the value. One thing that you sparked in that response is timing. And here we sit with a lot of uncertainty in the markets, economically and also investment markets. And there's always a degree of uncertainty. But let's talk for a moment about the implications of the market, the strength of buyers, what they're looking at, and how that influences multiples. Today we're dealing with tariffs as an example. Tomorrow, who knows what that'll be? There's always a ebb and flow there. But given your experience and where we sit today, maybe talk a little bit about the state of the buyer's market.
Yeah, so I was at a M&A conference in Scottsdale in January, and the investment bankers, private equity, fund managers, attorneys, CPAs who were all in attendance there were super bullish on M&A markets for 25. We've been in a down period in M&A ever since 22 when interest rates, started to go up. And while it came back to some extent last year, it's not nearly at the robust levels that we saw in 21. And people thought that there was really going to be a breakout with interest rates potentially being reduced this year, and also a decrease in the regulatory environment. And then the tariffs started, and that has injected a level of uncertainty that has certainly had negative implications for the public markets, and that has filtered through into the private markets. And in speaking with private equity fund managers just over the last 2 or 3 weeks, they're now not nearly as bullish as they were at the first of the year, and think that things are really going to be delayed by a couple of quarters, to probably Q3 of this year, maybe even Q4, before we see the real breakout that had been anticipated at the beginning of the year.
Yeah, and that's just an example of one set of circumstances right now with the uncertainty around tariffs. And so, if we take the question about timing and we take the uncertainty that comes with market volatility, again, I just want to echo what I'm hearing is that the sooner you can begin to plan, the better. And it may be a waiting game. You might get your company, ready to sell, and you've got the right team in place. But in order to extract the most value and find the appropriate buyer, it may take quarters, if not years, to put something together.
Yeah, I agree with all of that, and I think that's particularly the case if the company is in a cyclical industry that might be leveraged to capital spending because, as that's been muted now for a couple of years, and we could see another 2 or 3 quarters of really delays in getting that started. So I think cyclical businesses probably might be best advised to wait to see things really up on an upturn and maybe some more certainty in supply chains and this tariff regime.
What we'll do is, I know we wanted this to be conversational, but you've also provided us with a slide deck that is current, and this will be available to the audience if there's an interest in viewing it. I'm just going to proceed through a few of these pages and to ask you to talk about assessing the strength, weaknesses, and marketability of a company. You've touched on that concept that it takes time to assess, and again, the team, external and internal, can help you put that together. But if you wouldn't mind, maybe talk about a few of the next slide points, and when you'd like me to move to the next slide, just let me know.
Sure. So, for a while now, there has been a move among a lot of private equity fund buyers to preferring companies that have durable recurring revenues. And I can't tell you how many private equity funds have invested in, lawn maintenance companies, pool maintenance companies, companies that are doing any kind of home maintenance type of work because of the recurring nature of the revenue streams. Contracts bring, longer term contracts or even shorter term contracts bring uncertainty with respect to renewal percentages and the durability of those revenue streams. So recurring revenue is a much more favored type of revenue than longer or shorter term contracts where there's a question as to whether or not it will get renewed or not. I think obviously, I mentioned before, the cyclicality of certain business models. If you've got a highly economically sensitive business that might be subject to geopolitical or demographic factors, that could be problematic in the environment that we're in. Commoditization, is also an issue. So we might want to go on to the next slide, Sandy. You know, Consistency of gross profit margins, impact of inflation, in due diligence. As we were seeing, high inflation starting in 22 and extending on, into 23 and even the early part of 24. Part of the due diligence of buyers was to try to assess the impact that was going to have on margins and the sustainability of margins. Obviously, the more unique the products that are sold branded versus unbranded, branded is much favored type of product by buyers because of its uniqueness and brand recognition. Another one that is really important is customer concentrations. And by customer concentrations, if a company has a large percentage of its revenues tied up in just a handful of customer relationships. The company's ability to retain those relationships after a sale process is completed is a big issue that is normally a chiller on valuation. It also, to the extent that a company has a concentration in its customer base, you might see um, the purchase agreement have an earnout provision that protects the buyer in the event of customer losses, so that a portion of the purchase price is contingent on the retention of those customers post-transaction.
And
Um,
on the
yeah,
on the earnout, Carol, is it a fair question to say what the range is? Maybe that's sensitive to the economic cycle we're in, the particular industry. But obviously, the seller certainly would like as much of the proceeds up front. The buyer wants safety. So where do you find that sweet spot when it comes to earnout?
well, I think it depends on the specific, attributes of a particular or risks of a particular customer or a particular company situation. Um, there are certain industries like insurance brokerage where virtually all the transactions where you've got um, you know um, an existing customer base, virtually all of those transactions that we have seen have 3-year earnout structures. So, in some industries, it's just natural to have an earnout structure regardless of the specifics of the company. But, I think as a general proposition, you look at some of these issues that are on that particular slide, would drive depending on the extent to which a particular company might have any of those issues, you could see, an earnout at anywhere from 10 to 30%. The other thing is that it does depend on the nature um, of the M&A environment. In 21, for example, with the exception of the insurance industry and a few specific customer situations that did have, for example, high customer concentration, we saw mostly all cash deals, not a whole lot of earnouts at all. It was a function of, risk on versus risk off. And, it was very, very low interest rate environment, as you know, a lot of M&A activity, a lot of bullishness, valuations were very high, structures for a seller were just fantastic. So we just didn't see much in earnout structures at that point. Now there's quite a bit more uncertainty about the overall economy. Interest rates are much higher. So, the debt risk of, the meeting debt payments is higher than it was back in 2021. We've seen, some depression of valuations off of those 21 levels, and we've seen more earnout structures. So there are a whole lot of factors that contribute to, the level or existence of earnouts, but those are some.
Yeah, and again, that takes me back to your opening comment about uh, when you start the process, and the sooner you start it, the more organized you are, the more flexibility you have on the timing of it, so that as a seller, you'd have the opportunity to extract more value and find the right buyer. But if you're in a pinch, the uncertainty of the market certainly can work against you. I'm going to move through a couple of your slides, and this topic here, company leadership is something that you and I've chatted a lot about, and with a strong leadership team, obviously that's more attractive to buyers. But talk a little bit about what strong leadership looks like, what a buyer expects from a seller as far as how long they want them to stick around, and how does a how does the seller balance that with the value of the deal and maybe what they're looking to do in the next chapter of their life?
There's a lot to unpack with that
Uh,
question, Sandy. Um, you know, um, most of our clients have, um, um, let's say, 1 to 3 owners. I would say would be the typical situation, and so a relatively small ownership group, and that particular group of owners generally also are the core management team members. The question, when you go to sell the company, is how long are those team members willing to stay on, and at what degree of involvement are they willing to commit, you know, to the buyer post transaction, and how deep is the management team below that ownership group. And unfortunately, I would say that most of our mid-market or lower mid-market clients don't have a particularly deep management team. They might have 1 or 2 strong managers, but there's just not a large degree of depth there. So that probably eliminates even the prospect of selling the company to the management team, because of the risk of that management team succeeding post transaction, and being able to pay off a note that the seller's probably going to have to take with them, because that management team is not going to be as flush with cash as private equity or strategic buyer. So the amount of risk that the existing ownership team has to take in selling to the second level of management is going to be much greater. So we just don't see very many of our clients transacting with their management teams. It's normally a private equity buyer or strategic, corporate buyer that prevails.
Yeah, that's been my experience as well, and in visiting with our clients and seeing what's going on, and a lot of that has to do just with the attractiveness of the private equity markets and their interest in small to mid-size and even larger companies, and so the internal transaction is less likely. So let's talk about the transaction side of the equation, and I'm going to close off our sharing here for just for the visual aspects of things. Now let's talk about tax. That's right up your alley. On lots of fronts. There's so many things to consider on how a deal is structured, from the entity type to um, ultimately the estate tax strategy that might come into play even before a transaction is put together. Can you talk a little bit about entity type and the impact it may have on taxes?
Yeah. So let's start off with a C corporation. If the structure of the corporation is a C corporation, you have this concept of double tax, where if the assets of the company are sold, there's a tax at the corporate level, and then there's a second level of tax when the cash proceeds are distributed out of the company to the ownership group in liquidation of the company. So obviously that double tax is potentially problematic. There's there is the possibility under Section 1202, um, depending on a whole lot of factors that are probably too too much to get into on this call, that could result in significant exemptions of gain at the individual level when the company is liquidated. But historically, barring the ability to do that, um, you would try to do a stock sale if you could, but most buyers don't want to do a stock sale because they're not able to step up the basis of the assets within the company that they're buying, which, the ability to step up the basis and depreciate or amortize those assets, reduce the tax drag of the investment on the part of the buyer. So, you've got, this push-pull, negotiation between buyer and seller, where you've got a C corp structure that can be a difficult negotiation. One of the ways to potentially get around it, if it has to be an asset sale, is something called this concept of personal goodwill, which has been around for 20 years or so. Very positive court case. Martin Ice Cream was the first case involving personal goodwill. So there is potentially an opportunity to structure around it, but the underlying factual situation's got to be right. Then you have an LLC, which typically is or a partnership, taxed as a partnership. Those sales, can be done with pass-through tax treatment to the ownership group. Same thing with an S corporation, pass-through of gain, one level of tax to the ownership group. So what we typically see are LLC or S corp structures, not so much C corp structures anymore amongst our clients that are selling.
Yeah, you mentioned personal goodwill on the C corp front, and that is a facts and circumstances dynamic, but there could be some substantial tax savings if that were to work. Um, when you think about the overall structure of an entity, are there are there things that you could do beforehand to change the entity type or look at different types of structures in order to mitigate some of these taxes, or is it really you're kind of cemented where you are, and there's not a lot you can do to prep for the tax side of the equation?
Well, you could certainly convert from, well, one of the things that we do see with a lot of particularly private equity acquisition structures, where and this is another topic that we might be talking about, where there is rollover equity, where an owner is selling the company to a private equity firm, but not cashing out 100%. They're rolling some of their equity over and participating in the post-acquisition ownership along with the private equity fund. Um, uh, in that situation, a lot of times, if you have an S corporation, there's a structuring technique called an F reorganization, where the S corp drops assets down into a subsidiary and then converts that subsidiary into an LLC taxed as a partnership, and then the partnership transacts, or the LLC, I should say, transacts with a private equity firm so that the rollover can be tax-free to the seller.
Yeah, and that I think is a great example of the creative side of doing a deal, right? You've got what's my company worth? That's fluid. What are the tax considerations of the current structure? What could be done to alter that in favor of the seller and not at the expense of the buyer? And that's really, I think, where your expertise is so valuable. Uh, One thing that comes to mind too is on the estate tax side of the equation, or thinking about the family, not just from a tax point of view. One thing that we've worked on a good bit together is the question: how much does the seller need? Right? There's the other side of that coin is what's the company worth? How much does the family need? How much does the seller need? And what are the implications that that value might have on structure? And I guess where I'm going with that is thinking about um, any type of philanthropic gift before a transaction. Maybe talk for a moment, if you can, about the longer term considerations of deal structure and the implications it has on the seller, not just today, but future generations.
Well, what we typically see, particularly in larger transactions, um, let's say the seller has decided to exit the company and has made a determination as to your point, how much the family needs or wants to live off of, and there's going to be excess proceeds there that they don't anticipate needing, and there are estate tax implications. And let's assume for the time being that that family is not philanthropic. What we often see is, and it's even more important now, based on some recent tax court rulings, is prior to going to market with the company, the family ought to consult an estate planning attorney and consider one of several or several different types of estate planning considerations that could move stock out of their name into a trust for other family members, one or more trusts for other family members. We see gifts to trust. We see sales of stock in the company to trust. Typically, those transactions can be structured with discounts against the value of the underlying stock. So you really have arbitrage there between the control value of the company and the minority value of the shares that are being transferred into trust. So it can be extremely advantageous to the sellers to do this prior to a transaction and remove assets, from their estates. The other thing you mentioned is the philanthropic side. That is pretty much the same thing. If the owner group is philanthropic and wants to make gifts to charity, they can set up a donor advised fund. Uh, they could set up even a foundation if they so choose, or they could transfer stock to, let's just say, we're both here in the city of Richmond. They could transfer stock to the Richmond Community Foundation, and the Richmond Community Foundation would just hold the stock until the transaction occurred, and then would participate with the ownership group in getting cashed out.
Yeah, and again, back to the theme I think we're touching on, and that is the more planning you can do on the front end, the more flexibility you've got, the more time you've got to deal with some of the finer points, and ultimately, the more powerful the result can be when it's all said and done. Um, we could talk for a long time. It's fascinating to me, all of the considerations. But in the interest of keeping on our schedule, let me conclude with one question, and that is, given all the experience that you've had over your career, what's the one or two things that you can share with our listeners today that as a takeaway? If there's one thing they need to leave with, what would that be?
I would say if you're thinking about doing a transaction in the relatively near term, um, be thoughtful about pulling together your advisory team and start to interact with them on timing, valuation considerations, and estate planning considerations if the company is, has a very high value. And those all those members of the team can help, guide the owner in making the best decision about the best time, to take the company to market and hopefully have a very successful exit.
Well, that's great advice, Carol. And again, thank you for your time and your expertise. And with that, we'll conclude our podcast today. Again, Carol's presentation is available for the listeners, and we'll make sure that functionality exists. So, Carol, thanks so much. Have a great day.
Thanks for listening to this episode of Business Owner Bootcamp, presented by Wealthspire Advisors. If you have any feedback or questions, including suggestions for future topics and guests, reach out to your hosts or send us an email at clientrelations@wealthspire.com.